This is Philip Chow. I'm the founder and chief investment officer of Experiential Wealth. The roadmap that we think about looking at Fed's policy is divided into 4 phases. Phase 1 is the pace, how fast. The second is the scale, how much. The third one is holding it steady, right? In other words, we're not going up and we're not going down, we're just holding. That's third phase. And then the final phase is pivot, starting to reverse the policy. In this case, will be going down in rates. And that's the 4 phases that we use to examine where the Fed is now and where it may be going and which phase they will be in. The Federal Reserve has clear mandates by Congress, 2 of them. At least that's the one that we all know. One is full employment. 2 is price stability. Well, full employment is no question right now at between 3.5 and 3.7%. Historically have been just really, really low. In the old days, we think of full employment as 5%. So you can imagine 5 down to 3.7 currently. That's a big gap down, meaning that we are fully employed. So since 2021, late 2021, inflation was coming back. And the Fed didn't do much about it because the Fed really wanted to make sure that this is real. Because we have had a number of years of very low inflation. So what they want to do is sort of average the inflation rate to be closer to 2%. And it has always been for the last 10 years, before the last couple of years, been below that 2%. So their framework was to say, we need the inflation to be at 2, and it has been below 2. Well, let's get above 2 to average it out so it is still around 2. Regardless, 2022 came along and you see inflation really spiking up. So they said, well, we have full employment. So our job now is to contain and control inflation. And it's absolutely true. Inflation is most devastating for the lower wage families and individuals. Very obvious that they cannot afford the spiking of energy, food, housing, the basic necessity of life. So they start raising rates. So first they did 25 basis points, then realized that was just too lame, that's insufficient. So they keep raising until the 75 basis point 4 times, and then we end the year at 50 basis points. So we went up by 4.25%, which is huge in a 9-month period, started in March last year. But it's not done yet. So far, we're still at 3.7% employment. You say, well, I thought you liked that. Yes, we like that, except such a tight labor market is also telling you everybody's employed. Everybody's making money. Everybody's spending. The aggregate demand is there. If there's demand, and maybe there's some supply issues, inflation just go up. From raw material to finished goods, you name it. And also it didn't help during the pandemic years where people just sat on their couch and ordered nonstop. I think UPS and FedEx made a lot of money during those COVID years, just shipping the boxes to us of stuff that either we need or we didn't need, but at least we purchased. The Fed has been focused and continue to be focused on bringing inflation back down to 2%. Even more than that, they are focused on inflation expectation. So let me just take a moment. What is inflation expectation? If you and me and all of our friends and relatives said, you know, we really think that cars is going to go up by 15% in the next 2 years. And I think I'm going to have to replace my car sooner or later. Let's do it now. Because our expectations have changed. We expect prices to go up. When we expect prices to go up, we want to buy it now. Guess what? It makes it happen. By doing it now, we increase demand and there's not enough supply, so they have to go up in price. So it becomes a vicious cycle of demand and supply, right? That causes inflation. So inflation expectation is something that the Fed is laserly focused on, and they take survey after survey, and they use market statistic to see what people are pricing in future inflation. So far, it's still fairly well. They use the word anchored, fairly well anchored around 2%, 2.5, closer to 3, but still close enough. What they don't want is to see that run away, because once the expectation goes unanchored, inflation will be back, because we start kind of moving around buying things because we're worried. So they feel that although it's anchored, but they still worry because of the strong labor market. Now, don't forget, this inflation was started by too few goods because of supply chain. Then was the delayed demand. So the two of them were like going in and out of each other and driving the prices up. One thing we cannot do is to use monetary policy, raising interest rate, have no impact on supply chain. What, the supply chain is going to be all of a sudden come to life? Any more life than not? No, nothing happens. So from a supply standpoint, monetary policy doesn't do a heck of a lot. So where it does do a lot is on demand side. So we need to reduce the demand so far so that it will impact supply. That is a tall order. We expect and we anticipate interest rate to continue to go up in 2023, at least for the first half of the year. And Chairman Powell, has already stated that it's going to be around 5, a little over 5. So we think it's somewhere around 5.25 to 5.5%. We've been anticipating 5 for some time, but he affirmed it. So we're thinking around 5.25, 5.5% at least. So from 4.25 to 5.25 is another 100 basis point or 1%. So we're expecting the next 3 meetings to somehow make that happen. So that's what the Fed policy is doing, and it has significant ramification to investments and to our consumption, to the labor market. Well, they hope will have significant impact on the labor market. What they are trying to engineer is higher unemployment. Fewer people are working. I know it sounds terrible, but fewer people are working on the margin to bring unemployment maybe up to 4.5%, even 5%, which was the old fully employed statistics. So it still looked pretty good, but not as good as it is now, to bring down demand so people don't feel that I gotta go spend my money. They are a little bit worried. So will we end up in a hard landing, which is a recession, or will we be in a soft landing, which is basically very, very slow growth? Still not sure. But without that, inflation will not come down to 2%.